on Thursday morning, this was in the chat for Newegg. Okay. I mean, why? I don't know. But if you must get into it, do it right. Do it right. And you saw when I was talking about SPY with the 50% pullback level. So let's just be simple. Let's just look at this from a trading perspective. You want to get in. Let's just take a step back. Let's do a little meditation. And then draw up strategically how we want to play this. Say we come into the open like this. Let's just do it simply. Let's go from the top and go down to the bottom. And let's see, where is the halfway point of this move? Let's just see. So that's going to be about 44.58. Now, at the open, see if we can, yeah, at the open, a lot of people bought in because, oh, it's a big pullback, you know, I don't want to miss this. FOMO. And it actually hung out above there and enticed people for the better part of the morning. But it smacked that level, and at least one person in the chat caught it at that level, pulled a few $100 out of it on that day, held the level. This was a good move right here on a stock in play from here up to around here. That's about 15% move. That's very good. And what's more is it even hit it again at the end of the day, boom, and up it went again, 2 holds at the level. Will it do it again? Is that level still valid? TradingView data, boom, up again. 3 times it held this level. This was not the time to buy it in FOMO. But I get a lot of flack from people that say, like, oh, technical analysis. Technical analysis is worthless. Like, oh, you're just guessing, Okay, cool story. Yeah, you keep believing that. No, you can find levels like this that work. We did this in real time. We looked at it. What makes it so hard for people in trading is sometimes the easiest things. You just have to, again, lobotomize that stupid out of your brain that makes you want to jump in at the open on something and be patient for it to get to a level like this. And then you can have it just feels so good to catch it and do something strategically and be able to make money off of when everyone else is losing their shirt because they haven't gotten past that emotional point. So that's how you should have played NEGG. So yeah, great loss point there for people. So actually, there's another thing I want to talk to about NEGG as well. And this is, some people also wanted to do something dumb, which was buy puts. Okay, let me take that back. It's small brain. Okay, it's not that it's dumb, because thinking that something that's gone up a bunch will have a massive down move, that's using your brain. That's being contrarian. Good. But not understanding how options work and how volatility works, that is where you haven't done your full homework. And actually, for that, I'm going to need to bring up the chart in Thinkorswim, because that's going to give me the volatility that I want. So let's go back and let's look at our favorite of the year, GME, is volatility. And I've got an indicator here that charts it for me in Thinkorswim. Here was the price. So when price got up to almost 500, 478 back on 128, implied volatility of GME was at 542%. Now, just to give you an idea of how crazy that is, if you look at the SPY, the SPY's implied volatility right now is sitting at about 14. And at the highest it's gotten, is up about 30, 40%. So implied volatility is what options are. Let me back up. Implied volatility is what the market thinks that this stock is going to do, up or down, over the next 30 days. It's implying the volatility. And what happens is they price the options to encompass that volatility. In other words, they're going to make you pay insurance, which is what an option is, on the stock moving that much. And so if you're trying to buy a put at 500 and something percent IV, they've already priced in you not making any money if it gets down to 50 or returns to the mean. It's the price of the option at those time periods, at those days, are going to be so inflated. You could end up paying a few $100 for a 10 put when the stock is at $400 because it's pricing that in. In other words, something coming from 400 down to 10 is going to cost you $200 to break even. You need it not to come to 10, you need it to come to $8 a share because it's just so inflated. You should only have to pay $5 for a $10 put when something is at 400 because it's so unlikely in any given situation. But volatility expands to the point where it's already priced in. You're just not going to make money buying puts on these big high flying stocks. That being said, you can't short shares because that is incredibly dangerous. So, how do you play the down move? Well, you got to get creative. You got to get real big brain. And I don't actually recommend this for everyone because it takes a little bit of knowledge about options to do it. But I did a video back in January. There is a contributor to CNBC, John Nigerian, who I have a lot of respect for. He's been on there for a long time. He also sells options courses. But he described his put strategy on GME. And I made a video about it where I analyzed the risk graph. And depending on when he got out, he probably made money on it based on how it worked. So I'm actually going to go through that process right here, like how you should, if you want to get really creative, if you want to get really cute, play a put strategy. So let me bring up Tastyworks. Okay, and we'll make it work for me here. All right, make sure that, all right. All right, so this is Tastyworks platform, which I like for options because you can build complex option strategies and it shows you pretty much what you're looking at down here. So let's start from scratch. So what I want to do is, and we'll just go back to, let's see. We'll go back to TradingView here for our charting. So I want to bet on Newegg going down. Okay, so I want to buy a put. All right, so what I want to buy is a put pretty far down. Let's say we want it to return to where it started because that's what a lot of these things do. We want this to come down to about, let's say about 20. Let me make a different color for that. Mark off our levels. So I really want to get this thing below 20 because I think everyone that bought it at 40 is going to lose at least half their money. That's what I think, hypothetically. Okay, so I want a 20 put. So I'm going to buy a 20 put, and I'm going to go out to November because I don't know what weekly options are because I'm a professional. All right, so that's going to cost about, let's see, let me cheat here and find out what I had. Okay, I had 25. All right, actually it was 25 we're going to say because we wanted to get down to 20. Let's say 25 is the range that we're going to start looking at this to get. 25 is where we think this thing is going to break and eventually go down to between now and November. All right, so let's structure this up. So we're going to buy the 25, that's about right, for about $7.90. Okay, now there's a problem with just buying this put. We have a lot of theta that we're going to lose on a daily basis, and we have a lot of volatility baked in. Remember how we were looking at the volatility here? Volatility at the top on Thursday, or excuse me, Wednesday, was 322%. Yesterday, it was still 259, and then today it's come down to 219. And that's actually dropped a lot over the course of the day. And so for every percentage point of implied volatility, you lose Vega. So if you're looking at your options and you're looking at the Greeks and you see you have the Vega number every percentage point of implied volatility is how much you lose in Vega. So if your Vega is 4 cents, that means that for every percentage that you lose in implied volatility, you lose $4 hypothetically on your option. So if your Vega is 4 and you buy an option at 322% IV and it comes down to 420% IV, that's 100 percentage points of implied volatility times 4. It's about $400 just right off the bat. Now, if you have delta move down, which you did, you're going to get your delta value. So the price is going to go up and they're going to offset each other to some point. But all else equal, you're going to lose Vega volatility as it comes down and theta as the time goes. Just what you deal with options. So we have to offset these somehow. And the only way we're going to do that is by taking the reverse side. And that means selling options. So how can we sell some volatility and some time? Well, we can do it in two ways, and we're going to do both. We're going to take a short put vertical. And so we don't want to take it really close to in the money because remember, we have our 20 is what we want to go down to. So we're actually going to go pretty far down the chain. So let's take the 15.10. So we're going to do a $5 wide spread all the way down. And because volatility is so high, we're still able to get a really good premium here. We're still able to get about $1.50 in selling this put credit spread where we start to get in trouble around 15. All right. But remember, we wanted to get the 25. So back to buying that one. So that offsets the cost. Instead of paying $7.90 all up front, we're going to offset that by $150. And now we're actually going to be generating theta. No, excuse me, not yet. We're going to. That's the problem we still have. We still have a theta problem. Time decay is still going to affect our trade in buying this put very quickly, $3 to $4 a day. So we need to add a little bit more short volatility and long theta there. So what we can do is instead of just having the single, we can do what's called a diagonal, which means we're going to sell one more option against it. And so that we can get more theta decay quickly, we're going to go closer in time. So we're going to sell a put, a 22.5 put here against it. So now we have 4 legs. We've got our initial play, which is our 25 put that we want. This cost us the most. We've got our put credit spread that offsets us a little bit. And then we've got this shorter dated August 20, 22.5 put, which is still below our main option, our 25 November put. And what that's going to do is because it's closer to expiration, we're going to get more theta decay. So now we're actually looking at a positive theta trade. In other words, as time goes along, if the price doesn't move, we still are able to make money on it. We've also offset a very, very good amount of our Vega, and we're still directionally bearish. And what this would cost at the closing prices today would be about 410. I actually took a screenshot earlier of what this looked like about midday. And this is what it looked like when NEGG was at 51. It would have cost 345. And towards the end of the day here, it was about 450. So basically, if you would have put this on in the mid part of the day, I'm not sure what time this was. I have to go back and look, but you would have made $100. Now, the full downside risk on this, if you held it, and worst case happened, it went all the way down to zero, is you would have lost around about $650. That's if NEGG went to zero. But in most cases, you're just going to be out what you put up for in this debit here, 345 in this case. But by the end of the day, it would have been back up to 410. And if we look at some of the differences in the prices, if we compare left to right here, let's bring this over, hang on. So our main put, it went from 810 to 790. It lost 30 cents in value, even though $51 when we first evaluated it here, $46. We had 2.5 delta move in the stock, but we actually lost money on our put. How does that happen? Volatility crush. All the options are worth less, by the end of the day, because even though the stock went down almost $3 in that time, volatility went down to offset it. So even though we got the movement we wanted, we still didn't make any money on this option. This is why you can't buy single options on these hype stocks. You can't buy single puts. You just can't. It's dumb. You have to offset that. But because every option lost value, including our shorter dated August one, went from 225 down to 205, and then our puts credit spread also sold off, we actually would have made money because it would have been a debit 345 up to 410. So we made about what is it, $60 roundabout? Yeah, something like that. $65 just in that time from it going from 51 to 46. But if we just done a single put, we would have lost money. So if you're going to want to play these moves, you have to be smarter than your average, retail trader that just started a few months ago. You got to really dig into these complicated option strategies to offset all the aspects. So that is how you should have played NEGG. So